The three charts nobody is showing you. Silver $500, oil $369, gold resets. Everything surprised. Something happened in the last 12 months that most people completely missed. Not because the information wasn't available. Not because it was hidden in some obscure financial report that only hedge fund managers read. They missed it because they were staring at the wrong time frame. Silver ran from $32 to $121. A 250% move in under a year, the kind of move that appears once in a generation. And then it did what commodities always do after a move like that. It pulled back hard, from $121 all the way down to $64. Nearly half of the gains wiped out in a matter of weeks. Exhale sharply. And right now, silver is grinding sideways, stuck between $64 and $90 for over a month, chopping, bleeding, testing the patience of everyone who holds it. The comment sections have shifted. The excitement has gone quiet. The people who were posting rocket emojis 3 months ago have disappeared. And the financial media, who never talked about silver on the way up, are now suddenly very interested in explaining why it's finished. But here is what those people are not showing you. The charts I am going to show you today are not daily charts. They are not weekly charts. They are not even monthly charts. What I am going to show you today are charts that span 25 years, 45 years, and 53 years of price history. The kind of charts that only become relevant once in a generation. The kind of charts that most retail investors never even look at, because most retail investors are too focused on what happened yesterday to see what is building across decades. And right now, all three of these charts are telling the same story simultaneously. One of these charts shows silver with a measured target above $500. Another shows oil with a technical target of $369. And the third, the gold chart, shows something even more significant than a price target. It shows the early stages of a complete reset of the global monetary system. These are not opinions. These are not predictions based on gut feeling. The charts are going to show you the math, and the math is going to change the way you see everything that is happening in this market right now. Let's get into it. The silver chart, 45 years of compressed energy. Finally releasing. If you own silver right now and you are watching the price at $80 feeling like you made a terrible mistake, I want you to do one thing before you make any decisions. Pull up the silver yearly chart. Not the hourly, not the daily, not the weekly. The yearly chart. 45 years of silver price history laid out on a single screen. And when you do, you are going to see something that will immediately reframe everything. What has been building on this chart for the better part of 5 decades is the most powerful technical pattern in all of market analysis. It is called a cup and handle. But this is not some small cup and handle on a 4-hour chart. This is not a pattern that took 3 weeks to form. This is a cup and handle that has been building since 1980. 45 years in the making. Let me walk you through how it formed. Silver hit an all-time high near $50 per ounce back in 1980. Then it collapsed. It crashed all the way down to $4, from $50 to $4. That is the left side of the cup beginning to form. Over the following decades, silver tried to recover. It climbed back toward $50 in 2011, then crashed again to $12. It recovered to $30, pulled back to $18, bounced, consolidated, pulled back again. Every single one of those moves, every rally, every crash, every frustrating sideways period was building out the right side of that enormous cup. And the neckline of this pattern, the critical resistance level that had to be broken for the pattern to trigger, was not at $50. It was sitting at $31 to $30. That is the number that mattered. $31 to $30. In 2024, silver broke above that level. After 45 years of compression, after 4 decades of energy building inside this pattern, the breakout happened. Now here is where the math becomes extraordinary. In technical analysis, when a cup and handle pattern breaks out, you calculate the measured move target by taking the depth of the cup and adding it to the breakout level. The cup in this pattern is roughly $32 deep from the neckline down to the bottom of the formation. That alone gives you an initial measured move target. But there is something else on this chart that makes it even more significant. Embedded inside the larger 45-year cup is a smaller fractal pattern, a mini cup and handle that already played out and produced a move of over 800%. When you apply the same fractal mathematics to the larger parent pattern, the long-term technical target for silver lands at $370 on the conservative end. And at the end of a major secular bull market, when markets overshoot and momentum takes over, the spike target moves above $500. $370 to $500 plus, from a current price of $80. That is 4 to 6 times the current price. And the pattern producing those numbers took 45 years to build. Think about what that means in terms of the energy stored inside this breakout. When silver moved from $32 to $121 in 12 months, that 250% run was not the end of something. It was the announcement. It was the market telling anyone paying attention that the 45-year base had finally broken and that something significant had begun. Because that is what happens when a pattern built over decades finally triggers. The initial release of energy is dramatic, fast, and almost violent in its speed. But the first move out of a long-term base is never the complete move. It is the first chapter. The full story plays out over years, not months. And the consolidation we are sitting inside right now, the grinding, frustrating, sideways price action between $64 and $90, is not the end of the story. It is the rest stop between chapters. Every major breakout in market history has followed the same basic structure. The asset breaks out of a long-term base. It rallies hard and fast. Then it pulls back and consolidates. It shakes out the weak hands, the people who bought at the highs because of social media hype and sold at the lows because of fear. And then it goes again, stronger than before, to higher levels than before. That is the pattern. Breakout, rally, consolidation, second leg to new highs. And I want to be honest with you about something. I know that accumulation territory does not feel the way people imagine it will feel. People have this idea that buying the dip feels empowering and strategic, like you are the smart money making a calculated move. That is not what it feels like in reality. In reality, accumulation territory feels terrible. It feels like the price is never going to stop falling. It feels like you made a mistake. It feels like everyone around you, on social media, in financial forums, in your circle of friends, is either laughing at you or telling you that you got trapped. It feels like throwing money into a hole with no bottom. That is precisely what accumulation territory is designed to feel like, because the whole point of the consolidation is to shake out the people who do not have the conviction to hold through the discomfort. It concentrates the physical metal and the confidence into the hands of the people who have taken the time to understand what the 50-year chart is telling them. Look back at every meaningful bottom in this entire precious metals bull market. Silver at $12 in 2020 felt like disaster. Silver at $18 in late 2020 felt premature. Silver at $22 in 2022 felt like a trap. And every single one of those moments that felt the worst was followed by a rally to higher prices. The pattern does not change. The emotion does not change. The asset does not change. Only the price level changes. And at $80, the emotional experience feels identical to how it felt at $18. Fear, doubt, frustration, the creeping suspicion that maybe this time is different. The only thing that has actually changed is that the macro case for silver is dramatically stronger now than it was at any previous bottom. The 45-year breakout has confirmed. The fundamentals have aligned. The physical shortage is real. And yet emotionally, holding silver at $80 feels just as uncomfortable as holding it at $18. That right there tells you everything you need to know about how markets work. The best opportunities in financial history have always felt the worst at the exact moment they presented themselves. The gold chart, 53 years and a monetary system on the edge. Now let me show you the gold chart, because what it reveals goes far beyond a price target. It changes the framework through which you understand everything that is happening in the global economy right now. Pull up the gold yearly chart. 53 years of price history starting from 1971. What you see on this chart is a pattern that technical analysts call 3 drives up, 3 separate, distinct bull market moves in gold, each separated by a long consolidation period, and we are currently living inside the third one. The first bull move in gold was triggered by a single event. President Nixon ended the gold standard in 1971. Gold was suddenly free to find its actual market price rather than being artificially fixed, and when that happened, it moved from $35 per ounce all the way to $850. That is a rally of 2,400%. Then it consolidated. For 20 years. From 1980 to roughly 2000, gold went nowhere. It fell from $850 to $250 and slowly ground back up to $500. 2 decades of building a base. The second bull move began around the year 2000 and was driven by the global financial crisis, the explosion in money printing, and the first wave of serious questions about long-term dollar stability. Gold went from $250 to $1,920 by 2011, a 900% rally. Then another consolidation, 9 years, from 2011 to 2020. Gold fell from $1,900 back to $1,000 and spent years building back toward the $2,000 level. The third bull move began when gold broke convincingly above $2,000 in 2020. From that breakout level, gold has already moved from $2,000 to over $5,600 at recent highs. That is already a 180% move, and based on the structure of the previous two bull cycles, this third move is just beginning. But here is what makes this third move categorically different from the first two. The first bull move happened because the gold standard ended, a monetary policy event. The second bull move happened because of the financial crisis and unprecedented money printing, a monetary stress event. The third bull move is happening because the entire post-Bretton Woods fiat currency architecture is being openly challenged for the first time since it was created. What we are witnessing is not a cycle, it is not a trade. It is a generational monetary system stress test playing out in real time. De-dollarization accelerating across the BRICS nations, central banks around the world buying gold at rates not seen in recorded history, government debt spiraling to levels that make meaningful repayment mathematically impossible, war reshaping global trade routes, inflation refusing to stay contained, bond markets signaling stress in the very foundation of the system. This is not gold going up. This is the purchasing power of paper currencies going down against the one asset that has no counterparty risk, no government backing required, and no promise attached to it. And when a monetary system reset happens, when currencies fall against gold not as a temporary cycle but as a structural repricing, that the gold price does not eventually come back down. The new monetary order gets built on top of wherever gold has repriced to. That is what happened in 1971. That is what the 53-year chart suggests is happening again right now, but at a scale that dwarfs every previous episode. While investors worry about a $200 pullback in gold from $5,200 to $5,000, the 53-year chart is quietly telling you that this move has barely cleared its throat. The oil chart, the 21-year pattern, and what 3 on 69 oil actually means. Now let's look at the oil chart, because this is where geopolitics, commodity markets, and the monetary reset all converge into a single picture. Pull up WTI crude oil on a 25-year monthly chart. What you see forming across more than 2 decades is an inverse head and shoulders pattern, one of the most reliable and powerful reversal patterns in technical analysis, and this one has been building for 21 years. The left shoulder formed in 2008 when oil briefly hit $140 per barrel during the commodity supercycle peak. Then the financial crisis caused a crash. The head of the pattern formed during the catastrophic 2020 oil crash when crude briefly went to negative $40. An event that had never happened in the history of the oil market, and the right shoulder has been forming since 2020, with oil building a constructive base between $40 and $90. Recently, oil broke out of a red falling wedge pattern that had been acting as a compression structure within the larger formation. In technical analysis, a falling wedge that appears in the middle of a move is called a halfway pattern, meaning the move that preceded it is only halfway complete. When you calculate the measured move from this breakout using the standard formula of the depth of the inverse head and shoulders pattern added to the neckline, the technical target comes to $369 per barrel. I want to be clear about something. I know that number sounds extreme. I understand that looking at oil at $85 and hearing a target of $369 sounds like something from a sensationalist headline rather than a serious technical analysis. But here's the critical point. 2 separate calculation methods using 2 different formulas both arrive at the same target zone. The inverse head and shoulders measured move and the falling wedge halfway pattern independently confirm the same number. When 2 unrelated methods produce the same target, that is not coincidence. That is the chart structure telling you something. And the war is providing the fundamental catalyst that could take what would normally be a multi-year technical process and compress it into a matter of months. The Strait of Hormuz, the narrow waterway through which approximately 20% of the entire world's oil supply flows, is currently disrupted. The International Energy Agency has described the current situation as the largest oil supply disruption in the recorded history of the global energy market. Not since the 1973 oil embargo. Not since the Gulf War, in all of recorded history. 8 million barrels per day of supply have been affected. Iraq's oil production collapsed by 70% in March alone. Kuwait declared force majeure on crude shipments. The UAE and Saudi Arabia are running out of onshore storage capacity and cutting production simply because there are no available tankers to load the oil onto. And what does 369 oil actually mean for ordinary people? It means gasoline at $12 to $15 per gallon at the pump. It means airlines grounding significant portions of their fleets because jet fuel becomes unaffordable. It means trucking costs tripling. And since virtually everything you consume at a grocery store, in a store, or online arrives via diesel-powered transportation, that cost gets passed directly to you. It means food prices doubling. It means heating costs devastating middle-class households through winter. It means manufacturing shutting down in energy-intensive industries. It means inflation that makes the 1970s, a decade people who lived through it still describe as economically traumatic, look relatively mild. This is not fear-mongering. This is the direct mathematical consequence of tripling the price of the commodity that 45,000 products and the entire global logistics system depends on. The separation of paper and physical. The signal the charts cannot show. There is one more layer to this story that goes beyond the chart patterns, and it may be the most telling signal of all. Across gold, silver, and oil simultaneously, the paper markets and the physical markets are telling completely different stories. In oil, the paper price of Brent crude was recently sitting around $92, but the physical premium for an actual cargo of Dubai crude over its paper equivalent hit $38 per barrel, meaning real oil you can put into a tanker and physically ship to a refinery, is trading at $130, while the futures market says $92. Jet kerosene hit $225 per barrel in the physical market earlier this month. In silver, the Shanghai physical market is pricing silver at $94 while the COMEX paper price says $80. A $14 gap between where you can buy a paper promise and where you can buy an actual silver bar. In gold, with Dubai flights grounded and physical supply chains disrupted, an estimated 20% of the world's gold supply chain is currently frozen or severely constrained. The physical world is separating from the paper world across every major commodity at the same time. And here is the fundamental truth about that disconnect. The paper market always eventually loses that battle. It has no choice, because a futures contract cannot heat your home. A paper silver certificate cannot be fabricated into a solar panel or a semiconductor. A derivative cannot fuel a commercial aircraft. When the physical supply disappears, all the paper contracts in the world are simply renegotiated lower, or they fail entirely. There is one data point that makes the silver shortage impossible to dispute. A company called Monetary Metals is currently offering 12% annualized returns to lease physical silver from retail investors. They are partnering with StoneX, one of the largest commodity brokers on Earth, a major clearing member on the COMEX, to borrow physical silver bars from individual investors who have metal sitting in private storage. Normal silver lease rates are 1% to 2% annually. StoneX is offering 12%. Let the logic of that sink in for a moment. This is not a small operation. StoneX operates across 40-plus derivatives exchanges on 4 continents. They are embedded at the institutional level of the global precious metals market, and they are so short of physical silver that they are going directly to individual retail investors, people with silver bars stored in personal safes, and offering to pay 6 to 12 times the normal lease rate to borrow it. If there was no silver shortage, that arrangement would not exist. Nobody pays 12% per year for something they can easily obtain at 1%. That lease rate is not a statistic. It is a distress signal from the institutional level of the silver market. And institutional distress signals do not lie because they represent real money paying real costs to solve real supply problems. All 3 charts. One story. Let me bring all 3 charts together into a single picture, because when you see them side by side, what emerges is not just a collection of commodity trade setups. It is a unified narrative about where the world is heading. Gold is in the 3rd bull move on a 53-year chart, a move that, based on the pattern and the macroeconomic context, has the characteristics of a complete monetary system repricing rather than simply another commodity cycle. Silver has broken out of a 45-year cup and handle with measured targets of $370 to $500 plus. It is currently consolidating within that breakout, which is exactly where it should be at this stage of the pattern. Oil has broken out of a 21-year inverse head and shoulders with a technical target of $369. And the war is providing the kind of physical supply disruption that could accelerate years of technical pattern resolution into months. 3 different assets, 3 different chart timeframes, 3 different technical patterns, all breaking out simultaneously, all pointing in the same direction, all being given a fundamental catalyst by the same geopolitical events. This is not coincidence. This is the market expressing, in the only language it has, price action, that something structural has changed in the global financial system. The fiat currency architecture built after 1971 is being stress-tested in ways it has never been tested before. War is disrupting the physical commodity supply chains that the global economy depends on. Central banks are accumulating gold at historic rates, which means the institutions responsible for managing currencies are quietly positioning against those currencies. Debt is accumulating at a rate that cannot be sustained without either dramatic inflation or dramatic default. And physical commodity markets are separating from their paper equivalents in real time. Gold is pricing that reality. Silver is pricing that reality. Oil is pricing that reality. And the paper markets, the futures contracts, the ETF structures, the leveraged derivative positions that have long been used to set the headline price of these commodities, are losing their ability to keep the paper price anchored below the physical reality, because you cannot suppress physical scarcity with paper forever. The physical world always wins. What this moment actually represents. Every generation gets one window, one specific window, to be on the right side of a major monetary system shift. The people who bought physical gold in 1971 when Nixon ended the gold standard captured a 2,400% move over the following decade. The people who accumulated gold between 2000 and 2011 captured a 900% move. The people who are accumulating physical gold and silver right now, during this consolidation, during this period that feels uncomfortable and uncertain and frustrating, are positioning themselves for what the 53-year chart suggests is the third and potentially largest move in the entire cycle. And this time, the catalyst is not just a policy change or a financial crisis. It is a complete repricing of real assets versus paper promises across the entire global economy simultaneously. Silver at $80, after a 250% move and a healthy consolidation within the greatest breakout in its 45-year chart history, is not a disaster. It is a second entry. It is the market giving people who missed the initial breakout from $32 another chance to accumulate before the next leg begins. The smart institutional money is not selling silver at $80. They are borrowing it at 12% per year because they cannot obtain it any other way. They are paying 38 per barrel premiums for physical oil because the paper contract cannot get oil to their refineries. They are competing for physical gold through premiums in Shanghai and Dubai because the paper system is no longer reliably delivering metal. The war is not creating this situation. The charts, the 45-year chart, the 53-year chart, the 21-year chart, were already built before the first shot was fired. The war is simply forcing the resolution of these patterns to happen faster than they otherwise would. The daily chart shows chaos. The yearly chart shows direction. The 50-year chart shows destiny. And right now, the daily chart is showing consolidation and frustration, which is exactly what it should be showing at this stage of a generational breakout. The people focused on the daily chart will sell here and look back in 5 years wondering how they missed it. The people focused on the 50-year chart will understand that this consolidation is the gift, the rare second chance to accumulate at reasonable prices before the next leg of a generational move begins. 3 charts. $500 silver, $369 oil, a gold price that rewrites the global monetary order. The paper markets say everything is fine. The physical markets, the lease rates, the delivery data, the premiums, and the 50-year charts say something very different. Paper promises can be printed infinitely. Physical assets cannot. And in the end, it is always the physical world that decides what things are actually worth. This is accumulation territory. The charts are the roadmap. The only question is whether you're paying attention to them. Drop a comment below. Which of the 3 charts hit you hardest? The 45-year silver cup and handle, the 53-year gold 3 drives, or the 21-year oil head and shoulders? Tell me if you are accumulating during this consolidation or watching from the sidelines. I read every comment. If this gave you a new perspective, share it with someone who is staring at the daily chart in a panic. Help them zoom out. It might change everything for them. Subscribe for daily coverage of the long-term chart patterns, physical versus paper disconnects, COMEX data, and the war's impact on commodity supply chains. See you in the next one.